Stocks in the Asia-Pacific are trading mixed this morning.
For the Nifty, the support comes in at the same level that we put out yesterday, around the 19,600 level. The precise number is 19,620.
Revenues declined 18% on a sequential basis. EBITDA is down 44%.
All of them have a buy or an overweight rating on the stock, with the target price ranging anywhere between 480 to 520 rupees.
Good opening for the market, 30 points higher on the index. The mid-caps are up almost about 200 odd points as well.
The next catalyst is really going to be the kind of earnings upgrades, which we're going to start to see from the second half of this fiscal.
Due to the interest expenses, high interest regime, there is a stress on the NIMs.
The company is on its path towards a 10% non-gold composition in the short term.
Markets absolutely flat. The Nifty is currently blinking red and green.
The numbers need to be adjusted by about 2,000 rupees if you take off the one-off. So we'll roughly be around 14,000 rupees per ton EBITDA for India.
EBITDA margins have come in at 23.1%, which is a sharp beat as per our expectations.
All three parameters, revenues, margins, as well as profits, are slightly lower than what the street was estimating.
That was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me are Surbhi and Nigel. Hi guys. I think the action is not in the Nifty or in the sensex. It's all in these individual stocks, and we've been hit by a barrage of earnings. The latest one is Jubilant Food Works, where the stock is reacting positively. EBITDA has come bang in line with what the street was anticipating, 20.7%. The bottom line has been hit by an account of an exceptional loss in some associates to the tune of about 40 crore. The stock initially surged, now is cooling off a bit, but still holding up in the green with a gain of close to about 3%. Suzlon numbers were also out. Bajaj Auto, I think it's Asian Paints. If you just take stock of the markets and where we stand right now, in the last few minutes, there has been a little bit of volatility in the markets. Remember, today is also the Fin Nifty expiry. The big story, consumer stocks are on the way down. You've got weakness in Asian Paints, ITC for the second day in a row. Britannia is selling off. Kotak Mahindra Bank is under pressure. Was weak yesterday. It's followed it up with a downtick, and on the gaining side, it's got to be on metals. That's clearly the sector of the day. Chinese, there is hope that the Chinese economy will be revived, so that's pushed up the metal stocks here. The Tata Steel, JSW Steel, and just take stock of the way Hang Seng and Shanghai closed up, right? Hang Seng up 4.5%. China was up 2.5%. So that's clearly your sector is shining today, sparkling.
Well, that's right. Hopes of Chinese stimulus always helps. I think JSW Steel is reacting more today than when it delivered good numbers.
Yeah.
On that day, it crashed actually 4% from the top. But just taking stock of the Jubilant Food numbers, we had a few numbers that flashed. The reason that the PAT number got hit is because of an exceptional hit of close to around 40 crores, if I saw that number correct. And on a like-to-like basis, I think the degrowth that we were working with was around 2 to around 3%. It's come in with a negative, I think, 1.5% approximately. So I think we should get that number as well up for you on the screen. Yes, Domino's LFL likely to decline by 2 to 3%. That was the expectation. It's not declined by that much, so the street likes that. Explains why the stock has moved to the high point of the day. Mangalam will join us to give us a quick analysis on that front. But taking stock of the Nifty first, we went down today to around 90,632 precisely, and from there we did see a bit of a bounce. Now, we mentioned this in the morning as well, 19,600, 19,630. That's a crucial support zone. And that breaks, then we decline another 150 points and we move to around the 20 DMA. On the upside, though, writing is seen at around the 19,700 call, and that contract will expire in the next 2 days. So resistance for those call writers will be around 19,800, 19,780 odd. If somehow we can get to that level and get above that level, then we'll be bracing for some bit of a short covering bounce. However, the final 60 minutes of trade belongs to the Nifty Financial Services. Today's weekly expiry that plays out, we have support at around 20,411. That's the mark that we went to earlier today, and we bounced off that mark. But there is writing being seen at around the 20,550 call. And that tells you resistance is at around 20,575 odd. Let's see which way it swings. Last couple of Tuesdays haven't gone well for the bulls on the Nifty Financial Services. But today it's up close to around 0.5% from the low point of the day. Survey?
Well, guys, I guess it's really all about individual stocks and earnings. That's what this market is absolutely laser focused on. The only additional thing that I'll watch out for is for how banks behave, because right now the bank Nifty has recovered a tad bit. There was a point in time that suddenly there was a 0.5% fall on the bank Nifty that was compounding problems for the Nifty. So let's see how that plays out. There you go. Around 2 o'clock, we had a bigger decline. Now again, some recovery on the banks. But aside of that, you're getting very sharp reactions, both on the way up and on the way down. And you're getting some follow through from yesterday. Case in point would be TVS Motors, where the market has made up its mind, and that's a good reaction that's flowing through, 5% up on the stock and counting. Jyoti Laboratories could be an earning that really stands out. There's a 20% up move on the stock ever since the numbers came in. Bottom line has really jumped. Margins have expanded. So the market's celebrated some of the good earnings of the day, so to speak. And then you have, of course, the disappointments, and there are enough of them as well. Chennai Petro is case in point. And, of course, we'll talk more about Asian Paints. Asian Paints is a big one. I mean, take a look at it. There seemed to be nothing wrong with the results as far as Asian Paints goes. If you look at margins, there's an expansion at the gross level, at the EBITDA margin level, and yet the stock has been on a decline. You can argue that, yes, top line, there was a small miss, but clearly the market is not in a very forgiving mood at all. Smallest of misses, and stocks are getting pounded on the way down. We'll talk a lot about this and a lot of these big earnings as we go forward. Let's get started first with the technical call on the day. So Mitesh is with us as always. Good afternoon, Mitesh. What do you make of things? Nifty, Bank Nifty, are you taking any trades at all, or are you sticking to stocks?
Good afternoon, Surabhi. We have taken a good trade on the Nifty. And, I think I was looking at a slip below 19,700 as some kind of a trigger for more declines. But what has happened in the last 4 hours is that we've had closings around 19,660. So while we haven't added to our put positions and we haven't shortened the futures, if we see an hourly close below 19,660, 650, we would actually add on to that. And on the upside, since the last 4 bars have been contracting, what we've done is trail the stop loss about 19,725, 730 on the spot Nifty. If that gets taken out, then we'll move out of the short trade for the time being and re-enter once it starts breaking below 19,650, 660 support area. Having said that, I think Rima was highlighting the metals pack. I've got 2 buy calls over there. In fact, it's the metal stock which are showing very good traction. So Hindalco is a buy with a stop at 442 for targets of 460, and also a buy on Tata Steel, which I would recommend buying with a stop at about 116 half for a target of around 126.
Okay, those are some individual trading ideas, but on the Nifty, you will go short only if the Nifty breaks below the 19,660, 650 mark. But let's talk about Jubilant FoodWorks. Manglam is here with his key read on the numbers. Manglam?
Well, Jubilant FoodWorks, the numbers are slightly better than anticipated, especially on the top line front. The revenue of the company has grown by about 6.5%. The street was working with a number a little over 5%, so there's a mild beat out there. But as a result of which, the EBITDA is actually largely in line with anticipation. In fact, the margins are a mild miss on Street's expectations, mostly because of the denominator and not because of the numerator. The EBITDA is at 276 crores. The street was working with a number of 275 odd crores, but the beat in the revenue has meant that the denominator has increased, as a result of which margins are at 20.7% versus 21% anticipated. No problems with the gross margins as well. There's been a dip of 50-60 basis points, but that was understandable as well. What really stands out are 2 things in the numbers. One, the company has gone ahead and seen a like-for-like decline of just around 1.5%. The street was anticipating a decline of anywhere between 2 to 3 odd percent. And secondly, the number of Domino's stores that they've opened this quarter is 23. The street was working with a number of 45 to 50 new Domino's store additions. I would read this 23 Domino's store additions as a positive, largely because, the more stores they open, the bigger pressure there is on like-for-like growth. Whereas a small, increase in the number of stores would mean that stores would mature further, and that would give them better operating leverage as well. That's about the Domino's part. What they've done is gone ahead and increased their exposure in the Popeyes and Hong's Kitchen vertical, and they've opened a couple of Dunkin' stores as well. So for those who are looking at diversification away from pizza, well, there has been a bit of a movement in terms of the Hong's Kitchen as well as Popeye's exposure as well. On the bottom line, there is a big miss as per our expectations, but that's largely because of a loss in an associate of close to around 41 crores. This compares to the loss of around 11 crores same time last year. You put that back in, and even the net profit is largely in line with expectations. So 2 things that stand out: lower than expected decline in like-for-like growth and lower store additions in Domino's means that going forward, operating leverage would play out for them.
Okay, that explains the rise in the stock, though it's cooling off a little bit now. But I guess that like-for-like sales, same-store sales number has gone down well. But Mangalam, what went wrong with Asian Paints? I was looking at some of your numbers and the margins have expanded. I don't know, is the top line miss enough to cause this kind of a stir on the stock?
Well, you know, before the numbers, the stock had rallied about 20% in the last couple of months itself and was virtually at a record high, trading at 65, 66 times one-year forward earnings. And as the numbers have been reported, remember, crude prices have spiked as well over the last couple of days. So this is something that we'll have to watch out for. But despite all of this, there are more good than bad in the Asian Paints numbers this time around. 10.1% is the volume growth that the company has reported. 10 to 12% is what the street was working with this time around. Gross margins that have, those have expanded by around 520 basis points as against street expectations of 400 basis points expansion. And as a result of which, there's been a big beat on EBITDA of almost 200 basis points. And the net profit has come in at around 1575 crores versus 1350 crores as well. What's soft? Yes, definitely revenue is lower, 9182 crores versus anticipation of 9335 crores. My sense is that the company would have given a better price cut to the consumers to increase their volumes at a time when competitive intensity is likely to increase. So this is something we'll have to watch out for. And other smaller parts of their business did not do as well as the paint business. So international revenues actually declined by 1.5%, and bath fittings as well as kitchen business sales saw a decline of 12 to 28% respectively. The question is what lies ahead. Crude is now at a 3-month high. Competition is likely to rise in the paint sector, and the stock, again, like I said, was at a near record high going into these numbers itself. However, as per the management, they are confident of a robust festival season ahead. So let's see where it goes from here.
Okay, got that. Mangalam, thanks very much for the details on both those numbers, Jubilant Foodworks as well as Asian Paints. Let's welcome Deepan Mehta onto the show this afternoon. Deepan, great to have you on as always. You know, the market's reacting to earnings in a very interesting fashion, and I'll take Asian Paints as an example here. Like Mangalam explained, that the margins have expanded. There's more good than bad in these numbers, perhaps. But look at the stock's reaction, and to take up Mangalam's point on positioning, it's not like Asian Paints has rallied 30-40% this year. I mean, it's barely up in double digits. So what explains the manner in which the market is reading through? Is it just valuations? The market's not in the mood to expand multiples that easily?
Good afternoon, Surbi, and thank you for having me on your show. It's very difficult to give a reason to why a particular stock is down intraday. I think results have just come. Let them settle in. Let's see what the management has to say in the con call. But generally, I think investors have been gradually getting underweight in Asian Paints, some of the other paint companies. Not so much because of the performance, but more so, or even the valuation, but more so of the emerging competition. I think after many decades, they have got severe and serious competition from the JSW group, as well as the Grasim Birla group. And these are deep pocket competitors who are, prepared to wait and play the long-term game. So to that extent, they'll keep on chipping away at the market share of the existing paint companies. And who knows, you could expect a price war also looming in the next few quarters or years or so. And the valuations, of course, as you said, are not on the lower side. So keeping all of that in mind, I think generally investors want to be underweight Asian Paints. But I think the results are pretty decent, as you explained to me. But despite that, I think the stock is correcting. Maybe there's something which we are not caught on, which may become evident post the management commentary and the con call.
All right, Deepan, well, numbers are coming in thick and fast. So, Deepan, just stay with us. Let's focus on Bajaj Auto. That's the stock on focus post their numbers. Sonia's with us to run us through a quick analysis on that one. Sonia?
Well, thanks for that, Nigel. The numbers are strong, but they are lower than what the street was estimating. And if you compare it quarter on quarter to what TVS has done, TVS Motors actually outperformed Bajaj Auto on a quarter-on-quarter basis, both on gross margins as well as on the EBITDA margins. And that, I think, is the reason why Bajaj is down about 1% and TVS is up in the green. But if you just look at the, standalone numbers, they look quite good on the back of a low base of last year. They've recorded the highest quarterly EBITDA of 1,954 crores. As I said, the margins are good, 280 basis points year-on-year jump compared to last year. But they are 60 basis points lower than what the street was estimating, and hence a little bit of disappointment there. The balance sheet for Bajaj Auto has improved. The company has added 2,000 crores of free cash flows during the quarter, and the management says that a double-digit volume growth and improving exports is what aided the earnings this time. So core revenue growth of 30%, EBITDA up 50%, operating profit margins at 19% versus 16.2%, while profits have gone up 42%. But the important bit is, if you compare it to peers, compared to at least TVS Motors, numbers are out. TVS has had a better showing than Bajaj Auto, and the stock of Bajaj Auto has also run up quite a bit, 30% in the last 6 months. So some profit taking seen today. Back to you.
All right. Sonia, thanks a lot for that. Dipan, what do you make of this one? Numbers pretty okay, but in comparison, maybe relatively not so good. And after the run-up that we've seen, well, some money being taken off the table. Your take?
Yeah, I think just a minor miss, nothing major. I think Bajaj Auto delivered, according to us, more or less in-line numbers. And it's just that the stock has run up significantly and there was no wow factor in the numbers, so to speak, to drive the stock price higher, like what we saw perhaps in TVS Motors, where the numbers were exceptionally good. And also looking forward to Aisha's numbers, I think, which also should surprise the street. But by and large, within the automobile space, our preferences for the four-wheelers, we saw Ashok Leyland numbers were quite very impressive. Maruti also should come with a very good set of numbers. And within the two-wheeler space, clearly, I think Aisha Motors is going to be the company to watch. Although we were very impressed with TVS Motors numbers. Bajaj Auto, I think, because of its focus just on motorcycle segment, the commuter segment, that may have kind of some sort of a I would say slowdown or stagnancy in the 2-3 quarters down the line once this upcycle in motorcycle volumes is over and done with. So bit cautious on Bajaj Auto, neutral on TVS Motors, but very positive on Eicher. But overall in auto, let's be in the four-wheelers.
Yes, you made your preference for Eicher Motors known when we were discussing, the battle for, the bicycle space going ahead, motorbike space. What about ITC? ITC has finally started seeing some buying. Since yesterday and today, the stock has been very, very weak. And today it went down to levels of about 455. So from there, some buying has emerged and the stock has recovered about 7 rupees from that level. Do you think there are any re-rating, triggers left for ITC? This was the big one. It's played out. And one of the analysts said that there was some demerger froth which had built up when the stock rallied from levels of 440 to 500. That's corrected a bit. But from here on, what are the triggers for the stock to continue to outperform?
You're right. I think we are both searching for triggers. And I thought the entire ITC hotel demerger thing was not that shareholder friendly because 40% still remains with the holding company, and that again will start getting a holding company discount, which could be anything 20%, 60%, one can't really say. And that 40% stake of ITC hotels held by ITC will never really get unlocked at all. So from that point of view, the holding company discount will be even higher. Having said that, I think I'm not a great fan of ITC. There was a PE re-rating which has taken place and over and done with. And a lot of investors are expecting this kind of corporate action that also now has got priced in. So going forward, I don't expect the stock to outperform the way it has just now. End of the day, it's a tobacco company, which is a very, very mature industry, highly regulated. And look at the volume growth, they are in low single digit. And I don't know where the next growth phase is going to come for ITC, which is why I have a kind of an underweight and a cautious view on the stock.
Okay, so that is ITC. Well, on that note, we do have to take a quick break. We will do that with the news that the market is right now just trying to hold its head above water. The Nifty right now, 22 points on the upside, and the mid-cap index is also fairly flat. Very choppy day, but in a narrow band, barely 100 points on the Nifty today. Let's take that break. We'll continue our conversation with Dipan Mehta on the other side, and we will also have Ajay Vora of Nuvama Asset Management joining in.
Welcome back. Well, we have a few numbers that we're expecting later, and Dixon Technologies in the street is sensing a good set of numbers. And to be fair, the stock has run up a goodish bit in anticipation of these numbers. So I think in the last month or month and a half or so, the stock has seen a big rally. I recall that in the third quarter of FY23, they disappointed, and the stock had got smashed, slam bam. But now, in fact, it's recovered to around that 4,100 odd mark. Well, let's focus on the big mover today, though, Tata Steel. That one declared its number. So let's run you through the big takeaways. First, on the India business, the EBITDA per ton that they declared was around 16,000 rupees. But there was a component of one-off and other income out there. So stripped of that, actually, the EBITDA per ton was 14,000 rupees per ton, which is much better than the 13,500 that we were expecting. So that goes down as a beat. Better realizations helped them, better product mix and operating leverage as well played out. Moving to Europe, it continues to struggle, still delivering losses of more than $90 on a per ton basis. Out there, you had one of the blast furnaces in Netherlands that was shut down. So negative operating leverage played out there, and input cost as well was higher. The net debt as well moved up by around 3,500 crores odd. That was because of capex of around 4,100 crores. The management, though, they told us here on CNBC-TV18 that they have that aspiration to keep reducing debt by around $1 billion on a per annum basis. For this year, anyone's guess whether or not any number close to that will be possible. Moving to the big 5 takeaways from what the management had to tell us here on CNBC-TV18. On steel prices, they told us for the coming quarter, India's steel prices will be lower by 3,100 rupees per ton. Europe will be down by close to around 35 to around 40 euros per ton. Coking coal cost for the past quarter, it was higher by $10 per ton. But in the coming quarter, it will be down by close to around $50 per ton. So put both these two factors together, that's the realizations and input cost. The EBITDA per ton will be flattish in quarter 2 if you compare it to quarter 1. The UK business, they continue to have conversations with the UK government. Now there's a stable one out there. So they say change of government as well hurt them a little bit. But now they're hopeful of a positive outcome. And finally, on inorganic growth, they said they've acquired a couple of assets. They'd rather scale up those assets than bid for NMDC Steel or even Vedanta Steel plant. In fact, on that note, let's hear out what the management had to tell me earlier today.
Q2 will be about 3,100 rupees per ton lower than Q1 in India, and maybe about 35 to 40 euros per ton lower in Europe compared to Q1. Last quarter, the consumption cost of coking coal was about $10 higher, which is what we had guided. Both in Europe and India. Europe was a bit less, India was a bit more, but broadly around $10 per ton higher consumption cost in Q1 compared to Q4. If you look at it from a spread point of view, it's obviously going to be similar or slightly better. But I think there are costs beyond coal and iron ore and the steel price, and those are the costs that we are watching. So now we have both Neelachal and Usha Martin, and in Neelachal we can build a 10 million ton long products complex. So we are well positioned to grow in long products without having to acquire any new assets. And NMDC, like I said, we were not really keen on it because, again, between Kalinganagar and Bhushan, we can add another 15 million tons at least.
Well, Deepan, the numbers were better than expected, but I think the China stimulus is the one that's actually pushing the stock higher. But for the last many times that I've asked you, you're not being too optimistic on metal stocks. But let me try again. Since there's going to be a stimulus coming in from China, what's your view on Tata Steel or any other metal stock that you prefer rather than Tata Steel?
Yeah, Nigel, I think you have not changed. You have a fabulous bull market over here. Look at the way banks, NBFCs, automobiles, real estate, capital goods, travel, tourism. I mean, there are so many sectors which are in the green and which are doing so well, getting good upcycle after many quarters. Why you want to buy something which has got so much of volatility in earnings? I think every stimulus which comes from whichever government are opportunities to exit out of commodity stocks. And unless you are an industry insider, you should not be buying any commodity stock for that matter.
All right, Deepan, not being fair to them, but most of these steel stocks are almost at 52-week highs. But I take your argument. You'd rather get into a lot better names. Deepan, before we let you go, smaller companies have come out with their numbers. I don't know whether you track them. Suzlon, the stock is down close to around 5%. That stock has moved up in one direction. In the last 6 to around 8 months, I think it's more than double. So if any view on that, Vivek tells us there was an exceptional item in the base quarter. So that's why on a year-to-year basis, it doesn't look so good. But otherwise, the numbers are pretty stable. And Orient Pro, that's another one that's more than doubled in the last 6 to 8 months. So that's up 5%. Any view on either of these counters?
No, Nigel, I think I don't track Orion Pro, so wouldn't want to comment over there. But Suzlon, certainly, I think the prospects have improved since the Sun Pharma Group has started taking keen interest and a large investment position as well. And overall, I think capacity additions are taking place pretty decent across the globe as far as wind turbines are concerned. And with issues related, debt-related problems behind the company, I think you could look forward to incrementally positive numbers coming from Suzlon. Part of it may have got perhaps priced into the stock price, but I think the company may be still full of surprises on the earnings front as well. Given that the base effect also will come into play, as also the fact that a lot of backward integration also benefits will start to play out for Suzlon going forward.
Dipan, thank you very much for joining in. We also have Ajay Vora, Head of Equities and Nuvama Asset Management, joining in on the discussion now. Ajay, over the past 3 weeks, we've had numbers across sectors, IT, private sector, financials, auto names, whether it's two-wheelers or even four-wheelers like Ashok Leyland, consumer names, paints, HUL, etc. Can you tell us the top 3 takeaways from the earnings season, according to you, in terms of trends?
So good afternoon, Rima, and thanks for having me. So broadly, if you look at the overall result season so far, clearly, IT sector has been a bit disappointing. On the banking side, as expected, numbers have been pretty strong. But, there is a caveat to this. If you look at the net interest margins for most of the banks, they have been pretty high since a while now. And broadly, if you look at one of the largest private sector banks also, the NIMs are in excess of 5%. So I think the view that market has taken on the overall banking sector is that it is unlikely that the profitability of the banks in terms of the NIMs is likely to expand from here. And if, falling inflation will have some sort of impact on the overall credit growth also, then looking forward, if you look at what we had 17-18% credit growth, can come down to around 12-13%. So in spite of, really strong numbers from, say, ICICI or, other banks as well, we are seeing muted price performance in a way. So that is on the overall banking side. But auto definitely has surprised on the upside, a couple of names which has reported so far. But if you look at the ground level, there has been some sort of, higher inventory. And now anyways, we are into the monsoon period. So going into the festive season by the end of the quarter, there can be some sort of discounting or some sort of lower production. So my sense is that, although the numbers have been great, stock prices are not reacting to those really great numbers because people are not really much, certain about the outlook, at least for next 6 months or so. Apart from that, there will be certain, bottoms up stock stories where the numbers have been phenomenal and the stock prices have therefore done pretty well. But at an aggregate level, if you look at it, there has not been a major upgrade as such. And we have moved pretty quickly in terms of our valuation. So if you look at, March end, we were somewhere close to 16 times for the broader market. Now we have quickly moved to almost 20 times FY25. So to that extent, the upside on the valuation is also pretty much limited from here on.
Ajay, interesting you mentioned that because I was just going to touch on this. When the Nifty crossed 19,000, it did so with momentum. The journey from 19,000 to 19,500, it was sort of pretty rapid. And then 19,500 became the first resistance of sorts. And since then, now there's been a fair amount of back and forth. So what do you think has changed? Like you mentioned that, valuations, suddenly that whole argument is coming back on the table. So what's different? What do you think are the key triggers in the near term?
So honestly, on a 19,000 base, 400, 500 points would be like 2-3%. So it's very difficult to, take a call on 2-3% movement in the market in terms of valuation. But broadly, I feel that, I think maybe some time back when we had a conversation, FIs were pretty much underinvested in India if you look in the month of March. Having sold close to $40-50 billion over 2 years, their holding had come down pretty significantly to 17.5-18%. And therefore, if you look from the month of March till now, both primary and secondary market put together, they have infused close to $18-19 billion, which is a really big amount in a short span of time. So, therefore, the valuation re-rating has also happened. And I wouldn't say that we are trading expensive right now. But we are fairly, at a mean valuation of around 20 times, where the pocket of opportunities are now pretty much limited. So you had, something like an auto and a pharma, which were trading pretty cheap maybe 6 months back. But broadly, now somewhere the upside is there, but pretty much limited, not what it was earlier.
Hi, Ajay. Good afternoon. Nigel on this side. Ajay, when the last time we spoke, you gave us a couple of sectors and stocks that you liked. I think you mentioned about Pharma and Glenmark, I think was one of the names we discussed. Tell us something new. What's looking good?
So I think, as Nigel, I just mentioned that, now the opportunities are pretty much limited. But we have been, looking at this whole mid and small cap space. And
Yes.
I think that, considering the growth opportunity over there are very high versus the large cap, because, the businesses are pretty large and mature.
Ajay,
Yeah.
Ajay, if you could give us a couple of themes, a couple of names, that will be helpful, right? Because, maybe the headline doesn't go up so much, but as you said, there's plenty of value in some of these stocks. So if you could share some names.
Yeah, sure. So again, if you look at within pharma space only, there are a couple of, smaller names, which are OTC based businesses and focused in US. They are trading still pretty cheap. In addition to that, you'll find pretty much a couple of NBFCs who are affordable housing focused. There also, stocks are trading at 0.5, 0.6 times price to book on a very small base. And my sense is that, going into the festive season, you'll see a lot of action on the affordable housing side. So I think that the loan growth traction can pick up, and these kind of valuations of 0.5, 0.6 are not sustainable. So as I said that, both on the consumption side as well as on the export driven side, we are finding lot many opportunities which can compound at maybe 25-30%. So broadly, we are focused right now more on the mid and small cap side, where the opportunities are still plenty versus the large cap side.
You spoke about autos and how you like the numbers, the ones at least which came out. What about tires? Tire numbers were pretty strong in Q4, at least most of them. Do you think that's a bit of a secular structural trend? We could continue to see strong numbers from tire companies?
Yeah, Rima, I think, we have been pretty positive, and we own a couple of tire names since a year, and they have done exceedingly well for us. And we continue to maintain a positive view over there. If you look at, the stocks like CEAT and Apollo Tyre both, there has been a reasonable change within the industry dynamics. So if you look at, earlier the largest player would command a significant premium, and, the way the industry work was very different. But now, over the last 1.5 year, there has been a reasonable pricing discipline, and most of the companies, they have expanded their product portfolio where the margins are also better. So my sense is that, if the crude prices and the raw material prices stays where they are, because they are heavily dependent, the gross margins are heavily dependent on the raw material prices. My sense is that, both these names, CEAT and Apollo Tyre, have a significant upside from here on as well. Because if you look at the structure itself, the entire export opportunity has opened up in a pretty big way for these two guys. And considering that, the capacity has also increased sharply, the operating profit growth can be pretty significant. So my sense is that, both these companies are still in a very, fairly better position to deliver a higher earnings growth from here.
Okay, got that. Ajay, good chatting with you. Slightly shorter chat today, but appreciate you joining in on the show. Well, that's a view coming in from Nuvama. By the way, quite a few moves in the market. First, we should look at some of the Adani Group stocks, because there's a big move on a couple of names: Adani Transmission, Adani Power, Adani Gas. Adani Green anyway was up and about. Suddenly, the others have also started spiking higher. That's Adani Enterprises for you. So that's one part of the market that's suddenly very, very excited. And the other thing that's happened is that banks have been trying very hard to fight back and pull back from the lows of the day. Some of the larger banks on the Nifty. So whether it's an Axis or whether it's even an IndusInd Bank for that matter, or Kotak, trying to fight back and cut their losses. Therefore, the bank Nifties again, it fell. Now it's again back at the flat line. Let's take a break on that note. We'll come back on the other side, and of course, as usual, get you our last half an hour call. So Mitesh is going to join back in. Welcome back. As flat can be, the Nifty is not going anywhere. 10 points higher is all that you have on the index. So the mid-cap index is now trying to perk up a little bit. Mid-cap index is up at least 0.4%. Now, we remain with earnings because we have some big ones that will come out post-market hours, and L&T is one of those names. So let's go across to Vivek to get a lowdown on the expectations. The stock's really selling off now as we're getting into the last few minutes of trade. Vivek, take it away. So what should we watch out for?
Well, L&T in the next couple of hours, you should get a better sense. The company should declare its results anytime post-market hours. This time around is expected to be a good set of numbers, steady recovery seen across all of these segments. And in fact, the lower raw material cost environment is expected to aid execution as well as margins in Q1. Now, talking about the numbers themselves, revenues are seen higher by a little over 13%, coming in close to the 40,550 crore mark. EBITDA is seen higher by close to 16%, the core EBITDA, and margins consolidated are expected to see higher by around 30 basis points. Profitability is seen higher by 26%, coming in over 2,150 crore. Now, the main thing to watch out for, number one, the company has already said that it would be considering a buyback in this particular board meet. So the size of the buyback and the price at which this particular buyback will be done would be the key to watch out for. Along with that, the company would also be looking for a special dividend for FY23. So that will also be another key trigger in this particular results. What Macquarie says, there's expected to be a strong execution pickup. Infrastructure, hydrocarbon, as well as heavy engineering, all of them are expected to fire. Also, what Macquarie says is that this particular quarter, margin improvement may not be much. Margin improvement, according to them, is expected to be more back-ended towards the second half of FY24. A lot of important triggers to watch out for: order inflow trends, ordering activity, as well as how GCC pans out. All of this is something that we would be keeping an eye out for.
Okay, thank you very much for that. L&T had missed the mark on margins last quarter. The stock had sold off. So this time, the margin guidance, particularly in the second half of the year, will be crucial as the legacy orders with lower margins start wearing down. The stock, by the way, has sold off in the last few minutes, now down 1.5%. The other big one will be Tata Motors. And this stock has had a phenomenal run in the last 6 months. Sonia joins in with the expectations. Sonia.
Well, thanks for that. It's expected to be a good quarter for Tata Motors. The stock is up 65% in 2023 already. Now, this quarter, on a consolidated basis, we are expecting the revenues to rise to 1.01 lakh crores compared to 71,930 crores same time last year. It's, of course, on a lower base as well, so the margins will look, exaggerated at 11.8% versus 4.4%. But the big kicker in this quarter's numbers is Jaguar Land Rover. JLR's numbers were very healthy this time. It was an overall volume growth of 29% for JLR on a year-on-year basis. The margins are expected to rise to 12.5% versus 6.3%. A couple of things worked here. One, of course, was the supply chain constraints eased. The demand has picked up. The pricing has gone up as well for some of the new launches. Production has picked up for JLR, and all of this has resulted in a better performance. For the India business, it was a bit of a tepid showing because commercial vehicles, the growth was in low single digits. In fact, if you look at the overall standard, the standalone business, the India business saw a volume decline of 15% year-on-year because the commercial vehicle space was hit due to pre-buying that we saw in Q4. So weak India business, but very strong JLR business, and that will aid the Tata Motors numbers this time.
Okay, all right. Thanks a lot for that, Sonia. Well, let's go across to Mitesh Thakur, who joins us. Mitesh, at around 3:11, what are the calls you have for us? Buy or sell calls?
Well, buy calls as of yet. Titan is something which has reversed from a good correction in the last 10 sessions, and now is reversing from there, so could see some momentum. That's a BTST with a stop at 3,006 for targets of 3,060. And the other one which I like is Ultratech Cement. That's BTST as well. Keep a stop at about levels of 83.60 and look for targets of 84.45.
Okay, we told you about the big numbers to watch today. Tomorrow, there are three big ones: Axis Bank, Dr. Reddy's and Tech Mahindra. So let's quickly get you up to speed on what the street is watching when it comes to these three heavyweights. So Abhishek is standing by. Abhishek, Axis Bank, take it away.
To begin with, Rima, a key thing to watch will be the net interest margin. Analysts are penciling in a 20 to 25 basis point kind of decline in net interest margin on a sequential basis. So the net interest margin for Q1 could be around the 4% level. Motilal Oswal expects a loan growth of about 20 to 24% YOY, which could translate to about nearly 3% on a sequential basis. Total watch list is around 5,500 crore, which is about 0.65% of the loans. How that move will be seen closely. Asset quality largely expected to remain stable. Again, Motilal Oswal estimates gross NPA ratio at 2.1% when compared to 2% in the previous quarter, and Morgan Stanley estimates a slippage of 4,000 crore when compared to 3,375 crore in the previous quarter. NPA provisions could rise on a quarterly basis. Q1 is seasonally a weak quarter for all the lenders, and we have seen NPA provisions rise, so that is seasonal in nature. Management commentary with respect to outlook on their growth and credit costs will be seen closely. Our polls suggest NII growth of 28% YOY and about 2.3% sequentially. We are working with a profit growth of 44.5% YOY, while sequentially there was a one-off in terms of the provisions for Citi's acquisition, and that is why the number is not comparable. Back to you.
Okay, thanks a lot for that, Abhishek. Well, from the healthcare space, you have Dr. Reddy's. They'll be reporting their numbers tomorrow. Ekta joins us with the key expectations. Ekta?
Well, for Dr. Reddy's, the stock is going strong into its numbers. The revenue growth is expected to be over 20% year on year, margins of around 25 to 26%, and a profit of over 1,000 odd crores. Expectations are that the revenue growth will be led by the key drug Revlimid generic, which is basically the cancer drug. Multiple companies, remember, have launched the generic version of this particular cancer drug in the US markets. Multiple companies will be benefiting from it. This is expected to probably offset the pricing pressure in the US markets. Also, the other drugs which will probably aid in terms of Dr. Reddy's numbers include cardiac drug Vascepa. Now, the US sales estimate is wide because it will also include the main pharma acquisition this time. It ranges anywhere between $328 million to $370 million. This is versus $310 million in the previous quarter. Revlimid generic could contribute as much as $70 to $100 million versus $60 to $70 million in Q4. Estimates are that India could grow 5 to 10 odd %. This is because of divestment of brands, so one will need to see the adjusted growth. Also watch out for the contribution from the PLI scheme, which contributed around 30 crores in the previous quarter. Now, margins will be aided by the India business, lower raw material prices. The range is anywhere between 25 to 26%. Profit will be lower because same time last year they did benefit from a settlement, and the operational performance should probably aid in terms of the profitability this time.
Ekta, thank you very much for that. The next one is Tech Mahindra. But before we get into the numbers, let's quickly just pull up a 6-month chart of Tech Mahindra. And you would see the big re-rating in Tech Mahindra took place in the beginning of the year when the company announced its new CEO, Mohit Joshi. And hopes were quite high that Mohit Joshi will be able to increase the margins of the company, bring in that profitable growth. The stock did well. In fact, at one point of time, Tech Mahindra, despite all the IT gloom, was trading at a fresh 52-week high. But then when Infosys reported their numbers, and this happened just a couple of days back, you saw that downtake in Tech Mahindra. So from that 52-week high, which the stock was trading just prior to Infy's numbers, the stock has seen a correction of close to about 9%. So that's the setup. In terms of performance, well, it's not expected to be a good quarter. There is broad-based weakness across its verticals. Their top client has been under pressure, so the top line growth will come down. Decline by 1.6% in dollar terms. In constant currency terms, the top line could fall by 2%. At the margin level, we're looking at a margin of 10.5%. Now, in the prior quarter, the company's margins were reported at 9.6%, but this included certain one-off impairment costs, etc. The adjusted margins will actually be 10.5% versus 11.2%. So adjusted margins are likely to come down on a quarter-on-quarter basis, and that's what the street is going to be fixated on when the new CEO, Mohit Joshi, he's come on board, he's a CEO designate, but he officially takes charge only in December. The street is going to be watching out for the margin improvement for Tech Mahindra because currently their margins are at 10-11%. much lower than companies of their size. Companies of their size include an HCL Tech, Wipro, LTI, Mindtree. These companies have margins between 16 to 17%. And if you remember, recently we had a chat with the top management of Mahindra Group, Anish, and we asked him what would be a key ask from Mohit Joshi. He said it would be to improve the margins of Tech Mahindra. So Q1 is going to be weak, but the street will be tracking the outlook on margins very closely. Get into a break. On the other side, we'll be joined by Jay Bala of cashthechaos.com. Stay tuned.
Welcome back. The Nifty is still flat, but the mid-cap market really woke up in the last half an hour, you'd have to say, because the mid-cap index is up about 0.4%. And within the mid-cap space, there's a lot that's moving around. We named some of the Adani stocks earlier. I should point out that even Ambuja and ACC, both of those are also up and about almost about a 0.5%, 4% of a gain on those stocks. That's Adani Ports, of course. Pull out ACC Ambuja. There you go. Days high pretty much on these names as well. So big rally in the Adani group today. Well, let's take the conversation forward with Jay Bala of cashthechaos.com. Jay, good afternoon. Always good to have you on the show. So what's the thesis now? I mean, the market has been very, very range bound. The indices haven't done much since our last chat. So how are you approaching things?
Yeah, good to be here, Surbi. Thanks for having me on the show. See, the markets are very close to completing a short-term structure. As long as Nifty can hold about 19,590, it would portend continuation of the bullish trend. But if 19,590 by the break, we are looking at a deep correction for the Nifty within the bullish phase. So we'll watch 19,590 as a critical support for the Nifty to hold back. But there is a very significant breakdown for the market, and one part of the market which has been the leader, that is the FMCG space. So, if one more sector gives in, we are getting into a deep correction. But as long as we don't have additional negative inputs for the market, we'll see the market as continuing up.
Jay, I wanted to get your thoughts in on the FMCG index, the Nifty FMCG index, and even the individual stocks. Just in the last 2 days, the Nifty FMCG index is down nearly 3%. Bad news on ITC in terms of the merger, and now there is some sell-off, even post the numbers of Asian Paints, etc. What's the trend looking like? And if you have any trade on individual stocks there?
Yeah, see, most of the FMCG names I have talked about, which is reflecting in the FMCG sector. And the critical support for the FMCG sector is at about 51,124. If that goes, there's a very significant possibility that the bullish cycle that started from the COVID lows of March 2020 is complete, and we could see a significant correction for the whole sector. Watch out 440 on ITC, and HLL is also clocking lower lows and lower highs. So there is a very significant possibility that the sector is turning, and any additional contribution from one more sector like the banks or the capital goods or the autos, which are all looking tired and at near significant support, they can contribute to the overall weakness of the market. So when it comes to individual names, I have 3 longs, and there are some shorts. Like, Asian Paints might be a short, but which is coming from the FMCG name. So I have one is from a mid-cap, small-cap name, Iris Business Solutions, looking like the best at this current juncture because the small cap is likely to rally further. So placing a stop under 75 and expecting record highs past the listing it had in 2022, 2021. That's a potential for Iris Business Solution. The second is a long on ACC. It's looking like a short-term breakout from an inverse head and shoulder pattern. The medium term is still down, so be careful here. The potential for the stock to rally is about 2,100, maybe even 2,300 on a stretch. So a stop under the 1,750 is essential. The third is Aditya Birla Capital. The structure is very similar to what we saw TVS Motors a few weeks ago that we had identified, and TVS Motors is record highs. The Aditya Birla Capital structure is incomplete. The July high is probably clocked an incomplete move. So as long as the stock can stay above 180, there's potential to scale something like 205 to 220.
All right. Hi, Jay. Iris Business Solutions, that's the 90 rupee stock that you're talking about?
That's right. That's right.
All right. Market cap just 175 crores, I think. So yeah, that's one stock you're talking about. Well, in terms of the Nifty and the Indian equities, we react to 2 global factors. One is Brent crude as well as the dollar index. Now, both of them have moved a little unfavorably in the last few sessions. Where are they headed?
Yeah, see, Brent is probably within its last rows of its counter-trend move, and I pointed out in sometime end of June that Brent is likely to rally to 83 odds and then come back to something like mid 50s to 40s. But if Brent were to take out 87.5, that's really negative for the global markets because that will trigger the Brent setup somewhere at like 250 in the long term. But I'm not anticipating that. What I anticipate is that Brent to touch somewhere close to 83.5, 85, and then turn lower in synchronicity with global equities. So I expect stiff resistance for Brent about 83.5 to 85, and then turn lower. When it comes to the dollar index have been pointing out is very close to a significant trend change. I would ideally like to see one more lower low that clocks about 99 and then turns up. But if you see the dollar index spot print 101.92, the dollar index has already bottomed and we are in for a significant up move for the dollar index.
Okay, that would be quite interesting. Usually a rising dollar has been synonymous with risk aversion, but let's see how it plays out this time. Thank you very much for joining in, Jay. Good talking to you as always. Well, with that, we are down to the final few minutes of trade, and the tally is absolutely flat. 6 to 7 points up on the Nifty. That's all that you've got. But don't look at the index. It's not an index kind of day. It's really about individual stocks, whether it's earnings or news, because you've got pretty severe result reactions, earnings reaction or news reactions coming in. On the top side, in terms of a sector that moved today, then metals definitely stands out with hopes of more stimulus for the property market in China. That really worked well. Hindalco has actually beaten now Tata Steel and JSW Steel to take a pole position on the Nifty, going home with a very smart 4% up move on Hindalco. JSW Steel, Tata Steel are close seconds. The other gaining pockets of the market included the Adani Group, as I was mentioning. So on the index, on the Nifty, it's Adani Enterprises and Ports. But beyond the index, a lot of the other Adani Group stocks have had a good run. Some names like M&M and Titan on the upside. But I guess the Nifty story and the bigger headlines really are more about the down stocks than the up stocks today. Asian Paints would be a case in point, 4% lower. ITC more selling. L&T ahead of numbers, also fairly weak.
Well, that's right. Just 1 point. We had the Nifty Financial Services Index that played out expiry. So yes, the Nifty Bank ended in the red. But in fact, the Nifty Financial Services Index ended in the green with a gain of closer to 0.5%. It was a good recovery that we saw from the low point of the day. At the day's low, it was around 20,411, so more than 100 points on the day's low. And that's because stocks like SBI Cards, Shriram Finance, ICICI Prudential, as well as Muthoot Finance. Now, all these names, they were up anywhere between 1.5% to around 2%, and they are part of the Nifty Financial Services Index, but they're obviously not part of the Nifty Bank. So that explains why, in fact, we had the Nifty Financial Services Index that was higher, while the Nifty Bank was lower because of few of these stocks.
Interesting there. But just to take that point forward about some more banks than the ones which dragged us down, Kotak Mahindra Bank selling for the second consecutive day. So that was down close to about 1.5%. And it's closing below its 50-day moving average as well. IndusInd Bank, Axis Bank reports numbers tomorrow, and Axis Bank was down nearly 1%. On the gaining side, Nigel, it's all about your, I think the top 4 gainers today are all the stocks that you track. Hindalco, Tata Steel, JSW Steel, Ultratech.
Yeah, let's hope China keeps their promise. Because
whether it keeps or not, every time there's a buzz, the traders make hay. So they have a field day, a complete party out there.
And today it was definitely China because you had the dollar index actually that was stronger. And the dollar index is stronger, you have metal prices that react, in the reverse. So it was the China stimulus that boosted up these guys.
And Hang Seng was up 4.5%, right, by the close of trade. So that just gives you an indication of the kind of, buoyancy there is and hopes on China reviving economic growth there by way of stimulus. But we've come to the close of today's trading action. Absolutely flat on the Nifty and the sensex. But don't go anywhere. Our Tuesday special, Commodity Champions, comes up next.